Hi there, I'm European Dividend Growth Investor. Welcome back to another video about investing. As many of you know, my mission is to make investing easy for everyone. That's why today I'm going to share with you on how to practically invest using the magic formula created by Joel Greenblatt. It is a famous formula because it has historically outperformed the S&P 500 by quite a margin. But hey, don't worry if you don't know yet what it is, because today I will introduce this to you first. And if you are new to this channel and you like this kind of content, then don't forget to subscribe to this channel and hit the notification bell. This is how you will never miss another video. Ready? Let's get started. If you have never heard of the magic formula before, then I definitely would recommend reading The Little Book That Beats the Market by Joel Greenblatt. Joel Greenblatt wrote this book in 2005 to introduce an investment strategy called Magic Formula Investing. This book got really quickly very popular just by its simplicity, but more about that soon. Because Joel Greenblatt is not a little guy himself, you know. Joel is actually an American academic and hedge funds manager and an alumnus of the Wharton School of the University of Pennsylvania. He also currently runs Gotham Funds with his partner Robert Goldstein. Again, a person in the finance industry with a very interesting name, Goldstein. But hey, if you still never heard of Joel Greenblatt, then please look at his multi-decade performance. It's really unbelievable. As you can see here, over more than 20 years, he had a return of around 26-27% on average on an annual base. Just compare him to all the others. Even Benjamin Graham, the big ones, like he had a return of 8-9%. Then we have Charlie Munger, 21%. We have also Peter Lynch here with 14%. And we have Warren Buffett over a span of 55 years around 12-13%. Of course, I think over time Joel Greenblatt probably will move towards the mean, probably follow George Soros and Warren Buffett over time. But still, after 20 years having such a return is just amazing. And you know, a lot of this is just purely by the simplicity of his investment style. Because have a look at it. This is the magic formula. It consists of two components. The first one is a high earnings yield. How do you calculate that? Take the EBIT, so the earnings before interest and taxes. You can find this on the financial statements in any 10K. And divide it by the enterprise value. At the same time, look at companies with a high return on capital. Take the same EBIT, but divide it by the net working capital plus the net fixed assets. This sounds a bit complicated. More about that more, because in reality, we can use this really quickly and simple. But I'll show you that soon. Because also look at the multi-year performance of the magic formula. But as you can see, it started in 1988, the backtest, and at that moment in time, the formula brought in a 27% return versus a 16.6% return of the S&P 500. In the right column here, you can see the net return compared to the S&P 500 that the magic formula has been giving the investors that followed that approach. Most of the years, there was a clear outperformance compared to the S&P 500. I could only find the data until 2009. I know there is also more data until now. What I learned from that is that the outperformance was a little bit reduced compared to the other earlier years, as we could see here. Because, for instance, in the decade between 2000 and 2010, there was, simply said, not a lot of growth in the S&P 500. And investing in companies that have a high earnings yield and a high return on capital means that you're generally investing heavily in undervalued companies. So that was really the decade of value investors, and that's why we see this nice margin between the two investing styles, the S&P 500 and the magic formula. Okay, so but it's now 2021, and what many people often struggle with is like, okay, it sounds nice, I've read the book, I see these returns, but how can I actually invest in this? So first of all, you can screen stocks yourself using the magic formula. What you need to do is you go to a stock screener online and you look for stocks with a low price to earnings. This is effectively the inverted way of looking at the earnings yield. This is based on earnings after interest and taxes. So it's important to know it's slightly adjusted. But hey, I took this literally from the little book that beats the market, because Joel Greenblatt gives this to us as retail investors as the way to do it. At the same time, look for stocks with a high return on assets. So return on assets is what we mean with ROA. Here it's kind of the similar as return invested capital, but then you look at the assets and the return on the assets from the balance sheet. It's kind of similar. Sometimes there are some adjustments here that you need to be aware of, but overall, to keep it simple, you shouldn't really worry about that to make the magic formula work. What you then have to do is to exclude the utilities or the financial stocks. That's because they are typically already having a low PE and high ROAs, so we don't want to pollute the data set of lists with stocks with those kinds of companies from those industries. Also exclude foreign stocks like ADRs. We don't need them in this list either. Exclude stocks with a PE lower than 5. Why? Usually there's something wrong with them or something like that. And again, according to Joel Greenblatt, it just pollutes your data set. Last but not least, also exclude stocks that just reported earnings a week before, because there might have something happened to it, and which therefore reflects the share price and the earnings yield. So take those out, because such data might not have processed yet by the screeners that you're using. So what you do then is to combine those rankings. So you make one ranking, let's say a list of 1 to 3,000 with stocks with a high earnings yield, and then your second list with 3,000 stocks from 1 to 3,000 with a high return on assets. You simply then combine those rankings and you start to buy the top 20 or top 30 stocks. You invest then in these stocks every 2 to 3 months, but you only spend 20 to 33% of your money. So having said that, you don't need to put straight away 100% at a given time, at a given month in your top 20, top 30 list that comes out of this. You can do this gradually over time. But what is really important is you need to hold the stocks for a year and after that sell them. And to make this, this magic formula really working, you need to invest at least 3 to 5 years in it, because you want to really take out a bad year. Sometimes it doesn't outperform like we saw the S&P 500. So you need to let this process run a little bit longer, at least 3 to 5 years. So this is a way how you can do it yourself, and you start wondering probably already like, oh, okay, I need to go to Finviz or to the other stock screeners, set up all the criteria and everything. Yeah, I get you. So personally, I'm not doing it the do-it-yourself way, because there's actually a much easier way presented to us by Joel Greenblatt. So what you do is you go to magicformulainvesting.com. I will put the link in the description of this video, so that's easy for you to visit it. You create an account, and once you've created an account, you log in, and this is what you will see on your screen. What you'll do then, you go to the stock screener, and here's where you can screen for the stock. You have two options. You can take 30 stocks or 50 stocks, but there's another option that you can choose, and that's the minimum market cap. Why is this important? Maybe if your investing style is to avoid trading in penny stocks, then probably you don't want to have companies or stocks with a minimum market cap of, let's say, 10 million, 1 million, or whatever. If you want to have more blue chip oriented companies, you could make it 500 million. But there's a catch to it. Bigger companies with a larger market cap usually struggle more to have high returns. So it's really about the risk and reward that you choose here. So personally, I choose 500 as an example here. Give me 30 stocks and baba. Here you've got now 30 stocks with all the tickers, all the companies that currently have a high earnings yield and a high return of assets. What you can see here is that the prices are since 1 October, so since Friday, the last trading day of last week and the first trading day of the new month. What you can also see here is the most recent quarterly data. Earnings season is coming up now, so a lot can happen to these stocks in the upcoming few weeks once they start reporting their earnings. What you can also see here is the market cap in millions. So if you want, you could select some companies out of this or in this based on what you like or what you don't like. Personally, I don't apply filters. I am not going to take companies out and replace with others, because what I'm then going to do is actually I'm going to use my value investing approach on top of this, because I might have, for instance, a bias towards Dick's Sporting Goods. Maybe I don't like their shop and think like, okay, I don't want it in the list. So I'm not doing this because that will break for me personally the whole idea behind magic formula investing. Of course, if you know that the company has already filed for bankruptcy and is still on the list, you might probably want to take it out. But that would be probably the only reason why I would take a company out, nothing else. But I haven't done that, and I will now show you how I use these stocks, such a list, to really practically invest myself in the magic formula. So this is where the fun starts, because I've got an account in trading212.com. They introduced last year, I believe somewhere probably during the summer, pie investing. This is something that many of our American colleagues are familiar with when they have an account at M1 Finance or something like that. But nowadays it's also possible in Europe via trading212.com. So as per the 1st of September, I created a pie called Magic Formula 1 September 2021, as you can see here. I invested at that moment in time 10,000 zloty, so that's approximately 2,200, 2,300 euros, at once in the pie. So I'm not going to do this every 2-3 months a little bit. I did it at once just because I don't have the time to continuously maintain this. I want to do it just once off, once a year. And I'm not afraid to lose more money because of the timing here. It's a test for me. What I did is I copied all the holdings, and these are 50 holdings, from the stock screener, and I invested them in all of them an equal amount according to the magic formula. So in this case, it was probably 200 zloty in all of those. What you can see already that some companies have really performed poorly. As an example, Foot Locker, it's now on 162 zloty and I lost already 20%. But there are also companies that actually did pretty well. 11% up for Quiddle, 15% up for Innovia. But then again, Waiter Holdings, 30% down. So what it tells you is that you really need to be able to handle the volatility. If these would be individual stocks and I would look at them, I would get crazy because of this. It would be too much stress for me. But seeing that it is a pie, you can see already that overall, there's just a decline of 2.7%. This is not a lot. And, this is how I'm investing currently in the magic formula. I invested it all at once, and I've also turned the auto reinvest of dividends on. Last Friday, I received some dividends, so they will be reinvested again into this pie. So overall now, 9,985 zloty invested. And so far, I lost 270 zloty in just 1 month. But hey, this is not too bad, because if we look at the S&P 500 ETF, in the last month, literally the last 30 days, it went down 3.8%. So from that point of view, just in the last month, I've been outperforming the S&P 500 already by 1.1%. Not bad, right, for just a month. So to sum this part up, it's nowadays really easy to do this. It probably took me about 1 hour to create this pie in Trading212, so the functionality is really easy. So it shouldn't take you too much hassle to get started. But having said that, I would also like to share 2 learnings with you, which I think are important for you in consideration, because I wasn't aware of that when I started investing like this. First of all, learning 1. Trading212 uses quite a large spread, because what you can do here is you can trade in fractional shares. Having said that, that means you can buy 200 zloty of or 50 euro of all those stocks. So you don't get full shares, but you get fractional shares. What I noticed is that the spread when I started investing is quite huge. So literally I saw my account on 10,000 zloty. After investing the full 10,000, it was straight away 9,900 worth. It means Trading212 already took 1%, 100 zloty, so 100 divided by 10,000, 1% in costs. So it tells you that there are no transaction fees, but there are fees as can be witnessed by the spread that it's using. So straight away I was 100 zloty in minus. A second one, what is important to realize here, is that once you sell all, this pie after 1 year, at least in my case, I'm subject to capital gain tax on all the profits that I make. I need to pay 19% on that. So usually I'm a dividend growth investor and I buy to hold forever. Therefore, I'm hardly ever having capital gain tax. In this case, I will be exposed to that. So every year I will need to do quite some admin probably on 50 stocks to calculate the capital gains, at least for the ones that went up. If you're from America, the recommendation is to sell your losers just a few days before the year has been gone, has been passed by, and keep your winners a little bit longer because you might benefit in a positive way from the different tax rates between the two. But if you're, for instance, from the Netherlands, where you have a wealth tax and no capital gain tax, you don't really care, because that's how I look at it. You could just sell it and reinvest, and just in the end of the year, you sum up your wealth and you pay a tax on that. So these are two learnings I think that you need to really consider here. I was not aware of both of them before I started investing, but now I'm definitely am. Having said that, if you like these kinds of videos, remember to subscribe to this channel and hit the notification bell. Usually I post a lot about dividend growth stocks, also European stocks, but in this case I thought it would be nice to show my little experiment about the magic formula investing. Enjoy your week. See you next time.